Well, today I have a very special guest on the channel. Adam Taggart from Thoughtful Money is with me here today, joining for my walk. How are you, Adam?
I'm great, Michael. Hey, everybody. Very glad to be here again, Michael.
So I'm going to ask you the thing that you always ask all of your guests when you interview people, and that is, what is your current assessment of the global economy?
All right. I'll answer that in 1 second. I just want to acknowledge for folks that yes, I agree. I haven't learned from my experience. I am coming out on a walk again with fine hair that just gets whipped all around by the wind, with a gentleman whose hair does not move a micron in gale force hurricane winds. So yeah, I'm not sure why I put myself in this comparison, but I had so much fun the last time I had to come back, Michael.
I'm glad you did come back.
Well, thank you. Thanks for the question. So, I'd say at the core, I think we're at an inflection point. I think that we have been kind of coasting on momentum for a long time. A lot of that momentum being the tremendous amounts of liquidity that have been pumped into the system by our central planners, both on the monetary side and the fiscal side. And that has kept the economy growing, I think, a lot longer than it naturally would have. Folks probably remember heading into 2023, every analyst was pretty certain that we were going to be going into recession imminently, and it didn't happen. It was the most forecast recession that actually never showed up. And now we're at the point where I think all that liquidity, not only kept the economy out of recession, but it also juiced asset prices. And so people started, at least people with assets, started feeling pretty good about things. And we started getting talk of, it's not going to be a hard landing, it's going to be a soft landing. And then that morphed into, well, no, we're no landing, right?
Right.
Which is a bit of it's different this time, belief. And as longtime investors know, those are very dangerous words. But I think, the markets have come to believe that we dodged the bullet. And I would have said that pre-attempted Trump assassination. I don't mean anything political about that comment. But I think markets have believed that we're through the woods and everything's going to be fine. And I think that confidence is arriving right at the moment where the momentum is really starting to dissipate, and where we're actually really going to start to see the lag effects take hold, and the general underlying economic weakness of the economy start really manifesting. And then as part of that, we'll see the markets starting to react negatively in response to that. I'm not saying this is all going to happen tomorrow, but I think, again, sort of the momentum that we've had from the surge of liquidity, as that really begins to dissipate. Let me make a tide analogy, since we're here by the ocean. That big surge in tide covered a lot of things, a lot of evils, and now as it starts to begin to subside and recede, we're going to start seeing who's been swimming naked. We're going to start seeing bodies float to the surface, whatever analogy you want to use. But I think at a high level, that's where we are, and we can talk about specific reasons why I think that way if you want. Everything from slowing economic growth. Certainly this year has had slower GDP growth than previous years. We can see it in the weakness in the consumer. Retail sales are really beginning to struggle here. Lots and lots of data showing that the consumer household is really getting tapped out.
Absolutely.
We can even see it in a lot of struggling businesses. Business bankruptcies up tremendously this year. Layoffs, war notices, etc. So there's a whole host of warning signs there. But we can get into whatever you want to get into around that.
Yeah, we're going to talk about some of those weaknesses right now. So last time we talked about the soft landing, a lot of experts were still calling for one right now. However, it looks like we are on track to have a hard landing. In fact, unemployment has been ticking up at a pretty alarming pace, and the SOM rule says that every single time this happens, we'll have a recession. And I'll even put up a Fred chart for people to look at here for a second so they can see that each time the unemployment rate ticks up this fast, we do in fact have a recession. So, you just mentioned that a lot of people think that we probably dodged the bullet by now because it hasn't happened yet. However, a lot of the weaknesses that you just discussed are starting to show up. The unemployment is ticking up, the retail sales are down. So my question is, if this is all happening and we have proof that this has happened every single time in the past, why do you think people still believe that it won't happen?
I think that's just human nature, sadly. And there's the old expression that a bull market climbs a wall of worry. Optimistic investors, basically, they just don't care about the concerns. And as the bull market continues to grow, despite the worries, people worry less about the worries, and they get even more on the bandwagon for the bull. So I think there's really nothing kind of out of the ordinary about that. Wall Street, it's a lot easier to be a bull than a bear. Stocks go up something like 85% of the time. So it's easier to be bullish because the probability is in your favor.
Right.
But also, Wall Street makes its money by selling people stuff. So, it has an inherent bias to sell sunshine and to feel better about tomorrow than today, to make all that happen.
But to me, some of some of the success that we've seen in the stock market and the economy is also kind of fueled by that optimism, because people are kind of making moves and making trades that they probably wouldn't normally make, but because they feel so good about where things are going, they're kind of taking an extra risk right now.
Well, absolutely, and we can talk about that. I guess first, let me make a higher level comment, which is when we talk about how well Wall Street's doing and how bullish investors are, what we're really talking about is the relatively small percentage of people who own almost all the financial assets.
Right.
So one stat I mention often is 93% of all financial assets are owned by the top 10% of households.
It's wild.
And without necessarily trying to put a good or bad judgment on it, pretty much all of the policy decisions that have been made over the past couple of decades, whether you think they were necessary at the time or not, it's pretty hard to not agree that the outcome of our policy decisions have benefited the wealthy Americans much more, have benefited the top 10% much more than they benefit the bottom 90%.
Right. It's always been that way.
It's always been that way, but particularly now post-COVID, right, where basically we did these extreme stimulus packages that ushered in huge spike in inflation and cost of living. That impacts everybody, but it impacts the wealthy much less because living essentials are a much smaller percentage of their overall household wealth.
Sure.
Right? But what it also did is it dramatically increased asset prices, especially financial assets. And as I mentioned, the vast majority of those assets are owned by the top 10% of households. And those went up much faster than the cost of living did. So actually on a net basis, those top 10% way better off than the bottom 90% who are pretty much only just getting the increase in the cost of living.
Right.
Right? So we have to be mindful that when we're making these sort of sweeping comments, we're kind of talking about averages, right? And something I also say a lot, which is this is a really important time to understand the difference between mean and median. So when you look at average consumer wealth, it's not doing that bad actually right now. But the problem is if you look at the mean consumer wealth, it's actually doing quite poorly, and it's eroding quickly, right? And the difference there is that the top 10% are so much better off than everybody else that they're pulling the averages up.
It's actually the same thing in the housing market too, Adam.
It is, and I'm looking forward to talking about that with you. It's also the same thing in corporate America, right? When you look at the stock market, it's actually had a really good year, right? But the vast majority of those gains are really coming from like the top 10% of stocks.
Yeah.
They're doing so phenomenally well that they're pulling the indices, the averages, up with them. But if you look across the full market, a lot of companies that haven't done very well this year. When you look on the equal weight basis versus market cap basis for the S&P, the difference between the two is incredibly stark. Market cap's done great, equal weight's barely positive for the year.
Yeah, I feel like we've never really seen anything like this before, at least ever since I've been keeping track. I mean, you're older than me, and we've never seen a situation that I can remember where you have such a small percentage, a small handful of stocks and companies, and in the case of the housing market, sales, that bring up the median so much that it still makes the numbers look good.
Yeah, I think the 20s were sort of one of the last times we saw something like this, and of course everybody knows how the roaring 20s ended. Right?
Yeah.
So I think, so back to your question, which is, are people being overly, or do we have irrational exuberance back in the market, given what's likely to happen from here? I would say from the preponderance of experts that I talk to, I would say the answer is yes. From a fundamentals basis, I don't know almost anybody that I've interviewed who says that they can make a really airtight case that today's valuations are justified by the economic fundamentals or the fundamentals of most of these companies. I mean, so much of the increase in stocks over the past year plus have been not from earnings growth, but from multiple expansion. And multiple expansion is just a fancy way of saying that people are just willing to pay more for the same thing. So, if you look at the work of analysts, say like John Hussman, they'll look at how stretched valuations are today from fundamentals, compare it to past periods in history, and essentially what they come up with is that the expected returns of the stock market over the next 10 to 12 years at this point are projected to be negative. And that's just because prices have run so far ahead of fundamentals at this point. Now, that doesn't mean that the stock market necessarily is going to return negative 3% a year for the next decade, although it could. But what's more likely to happen is just sort of a lost decade where we have some years where it goes up, some years where it goes way down, lots of volatility, but 10 years from now, you kind of end up basically back where you started. And that can be a very dangerous, damaging time for investors, both large and small, especially for folks that watch your channel, Michael, who I'm going to assume, a little bit on the older side. They have wealth. They're trying to figure out how to protect and grow that wealth.
Yeah.
I don't know too many people who say, hey, I don't care if I lose a decade of returns, right? There's a lot of people who say, I don't have the time to make up for that if I do. Right?
It's not just losing a decade of returns. And if you're flat, then inflation is eating away so much more of that. It's even worse than being flat. You're actually going negative.
You're exactly right. Right. So you're thinking correctly and thinking about it on a real basis. Right. We're just talking in general about the current level of distortion in terms of maybe prices getting ahead of themselves. Right. We haven't even really talked much yet about a recession. Right. So,
we're going to get into that.
What if it's not just the status quo? What if things actually get worse from here? Right. And you talked a little earlier about how we're beginning to see the unemployment rate creep up. And I want to be clear for folks, we're not seeing too many danger signs right now that suggest, everybody assume the crash position, this is all going down tomorrow. And 4.1% unemployment is historically really low, right? But I want to talk to a couple of data points relative to the chart that you just pulled up about unemployment, just so people have a sense of how this generally works throughout history. So I don't know if you're able to pull this chart up, but you can get it off of Fred, and it's just a simple chart of the federal funds rate over time.
Yeah, I'll throw it up.
And what you'll see is history shows a pattern of the Fed raising interest rates, hiking them up, then they plateau. They stop hiking, but they haven't started cutting yet, so they plateau for a period of time. And then the Fed realizes, oh my goodness, we hiked too much. And you'll see in this chart, that's right where the recession starts. Now, we don't usually know at the time the recession is starting at that point in time. It's usually declared, a year or two later.
Sure.
But the Fed gets the sense from the data it's starting to see, oh, you know what, the economy is actually slowing faster than we wanted to. We enter recession, and then the Fed is panic cutting all the way through the recession, right? And if you look back through the past, 40, 50 years, That's been the pattern. So if you look at what's going on right now, we've hiked rates incredibly aggressively. They've now been plateaued for a good while. You have to have a really good argument why things are different this time to negate the pattern of the past half century. Right?
Yeah, absolutely.
So that's one thing people should note real quickly. To your point about unemployment, very similar. You can put your same chart back up. The thing I want to point out here is that unemployment tends to, once you're through a recession, unemployment starts coming down, right? It gets back under control, and it remains really, really quiescent. Like it's just this slow, steady decline, then it flatlines, everything's good. Then it starts turning up, and then bam, you hit a recession and unemployment spikes. And again, if you look back on this chart, pretty much every other previous recession on the chart, that's been the way that things have worked out.
Right.
You see where we are now, we were coming off a period where unemployment came down, very, very, very quiescent. It's now starting to come up. And so again, you have to have a really good argument for why it's going to be different this time for history not to repeat.
Yeah, that's why I like that chart with the SOM rule, because it's not just the fact that it's 4.1% unemployment, it's the fact that it's going up at an alarming rate. It's going up faster than what it should be going in if we were not going to be hitting a recession. That's kind of like, one of the points that they talk about with this. But, the reality is we're already on the verge of the Fed cutting rates right now, potentially in September. And it looks like the yield curve is maybe starting to uninvert, which is another economic indicator that we have that always signals a recession as well. Usually when it uninverts, that's when we start hitting a recession. So a lot of things are kind of lining up at the correct timing for this to potentially be happening.
Absolutely, absolutely. And what's interesting about interest rate cuts, you're right. That's exactly, it's so funny. And this is where the market, I think, tends to just have sort of selective amnesia, right? So, right now you were kind of asking me earlier, how come the market is basically blind to the risks that are out there?
Right.
A big one that it's blind to right now is the data set that I talked about earlier, which is it's always when the Fed starts to cut rates after that pattern of aggressive hiking and then plateauing. It's right when the Fed starts to cut rates that's when the wheels come off, right? But right now the market's just been in this chronic mindset of, Fed rate cuts mean we go back to the salad days we had before, asset prices go up, that's going to be the solution to all our problems.
Yeah.
History shows no, that's when your problems really start.
Well, that's one thing that kind of makes me believe that the recession has already started. I know I feel that way, and a lot of other people who watch my channel feel that way, because when you look back at like the chart you talked about earlier, just showing the Fed funds rate, they called the recession at the end of 2008, when in reality we were already in a recession for a year at that point. So
right.
They were way behind the curve, like they probably are this time, and it doesn't become official until it's already been official for a long time.
Yep. Well, so there's that old saying, right? It's a recession when your neighbor loses their job. It's a depression when you lose yours, right?
Right.
I think there are certainly cohorts of the consumer right now that would say, hey, they're living in recession times right now. And certainly with the increase in cost of living, yes, wages have been positive on a real basis for much of the past year, but they have not. I think the surveys say something like 70% of Americans say that wage increases have not kept up with their cost of living. So net, they're feeling further behind. Layoffs, 2023, much higher than the previous couple years. 2024 has had some of the most aggressive layoff months, even compared to 2023. As I mentioned earlier, warn notices are spiking. That's a notice that a corporation needs to provide, I think, 6 months in advance when it's planning on doing layoffs beyond a certain scale. So, we're seeing lots of signs that there is growing weakness in the economy. Right now it's not enough to impact the averages yet, but I think it's getting to that point, which is why I sort of started all this at the beginning by saying I think we're near a tipping point. Wouldn't surprise me at all if when the recession gets declared, if it had started now, I wouldn't be shocked. That being said, I think you can definitely still have an honest debate about whether we're truly in a recession or not, depending upon what part of the economy you're talking about, what cohort of consumer class you're talking about. I'm pretty confident, Michael, that at some point in time, wouldn't shock me if it was within the next 12 months, you and I are having one of these walk and talks, and it's no longer a debate.
Yeah.
We can just say, hey, everybody agrees we're in recession now. And I was just interviewing two people who I recently interviewed. I'll just mention here. One is Anna Wong. So she's the chief economist for Bloomberg Economics, and she has worked at both the Federal Reserve and U.S. Treasury. So she kind of knows all the different parties in play. She and her team have the highest unemployment prediction on the street right now for 4.5% by the end of the year. Now, 4.5% isn't that bad compared to where it usually goes in a recession. It could easily go to 6, 7, 8% in a real recession.
Right.
But even she is saying, hey, by the time it gets to 4.5%, it's going to feel like a recession for most people, right? So you're starting to get some mainstream economists, beginning to basically say, hey, yeah, we should really start, again, not prepare tomorrow for this, but prepare next 6+ months that we should start feeling a lot heavier, more forceful winds battering the economy than we do right now. I also, just a few hours before coming down here to meet you, interviewed Steve Hanke, who's an economist. He teaches at Johns Hopkins University. He nailed the prediction of 9% inflation. So he was out there publicly predicting it. And I was one of the guys that interviewed him probably about 6 months before it peaked at 9.1%. And he was calling for 9% inflation by pretty much the time we hit it. And, and kind of taking his deserved victory lap there, he said, look, I don't really deserve the credit for it. It's Milton Friedman. All I did was use Milton Friedman's quantity theory of money formula, which just mathematically tells you, hey, if you have changes in the money supply and a few other factors, this is what should happen to inflation. So using that same formula, he believes that inflation will be down at about 2.5% by the end of this year, to going to 2% or below, probably relatively early on in 2025. And accompanying with that, he says, recession's unavoidable. So I just want to say this, what I'm giving you is one guy's synthesis of all the folks that I talked to.
Yeah.
But there's a lot of folks out there who are now feeling increasingly confident, kind of sticking their necks out and saying, hey, I'm beginning to predict recession. I'm beginning to predict not just recession as defined by 2 quarters of negative GDP growth type of deal. I'm predicting recession of like people not being able to get jobs, the kind of widespread suffering that we don't like to see in a recession.
Sure. So another point about that is last time you and I talked here in the Bay Area, you said that if inflation is tamed by the time we hit a recession, then the Fed may have some room to cut more aggressively. So do you think that's still going to be the case once the recession gets called? Because the chart shows that that's what they always do, but they're just now supposedly getting inflation tamed. And if Steve Hanke's right, then inflation might reach their goal sometime next year. But then if they start cutting rates aggressively, we're going to be having more problems with inflation again, most likely.
Yeah, to what I said, yes, I think the Fed has more room to cut than they'd had in the previous 5 or 6 years. And
Right.
it's simply because interest rates were down at rock bottom lows, right? So one of the benefits here is the Fed does have a little bit more ammunition in the tank than it did if a recession had hit, assuming COVID had never happened. If a recession had hit in 2020, it wouldn't have been as well prepared. Now, that being said, I'm just talking about interest rates there. And let me also be really clear, because this will be germane to housing when we get to the housing part of this discussion. Again, I think the market's expectations about the impact of rate cuts is erroneous right now, where I think they are thinking the Fed starts to cut rates and we go back to happy times immediately, right? And one of the things I talk a lot about on my channel and try to remind people about is the lag effect, right? Which is that Fed policy acts with a lag.
It seems like it's only just now starting to take hold, really.
Exactly. And actually talking to Steve Hanke this morning, we talked a lot about how was he able to predict with so much accuracy, and a big part of that is the lag effect. And he said, well, I had to look back at when we started changing the money supply, and then I added 2 years onto that, because that's what Milton Friedman basically said is the average time that Fed monetary policy changes take to ripple through the economy and finally express themselves. And, in that case, he was totally spot on, right? So, yeah, we're now just now beginning to start to feel, I wouldn't even say yet the full force, but certainly more of the full force of, all the policy changes that were made 2 years ago, right? So, housing market, people are saying, okay, once the Fed starts bringing rates down, that's going to rescue the housing market, right?
Yep.
I actually think it may even have, I think the answer is it's probably not, at least not for quarters to years. And I think it actually might even have a worsening effect, which we can talk about in a little bit, because I think the punchline there is I think lower interest rates might increase supply at a faster rate.
Yeah.
And if that does, then obviously that helps to push prices downwards. Yeah, it's really important to understand the fact that if the Fed is able to start cutting this year, it may not have the instantly salubrious effects that so many people are expecting. And I think the odds are probably good that the Fed will start to cut this year. But a couple things to keep in mind about that. One is the Fed's going to have to do so gingerly, at least at first, right? Because right now we have conditions, if you just look at the headline numbers, right? Economy is still growing, stock market's pretty much near all-time highs, real estate market's near all-time highs, unemployment, while beginning to creep up, still near record lows,
Yep.
right? So these aren't conditions where you typically have an easing campaign by the central authorities. In fact, they're much more like conditions where you have a tightening campaign by the centralized authorities, where they say everything's doing well. In fact, it might be doing too well. We might need to cool off the economy. So obviously, the Fed's talking about doing the opposite here, but it has to be very careful about it, to your earlier point, because inflation is not yet slain, for sure. So it risks, by cutting too early, that it can restoke inflation, and then we get stuck in a 70s loop, right? Where we have, inflation that rises and falls, and we can't get out of that cycle, right? The other thing to note is that because it's going to have to do so gingerly, maybe it can cut once, maybe twice this year, cut maybe a few times, over the first half of 2025, whatever. So we're a year from now, Michael, right? And okay, maybe the federal funds rates come down from 5.25% to what, 4.5%?
Probably 4.5%. Yeah.
That helps, but it's certainly still much higher rates than the economy was used to, up until about 3 years ago, right? Mortgages are still going to be way higher than they were when people were getting mortgages at, less than 4%, less than 3%, et cetera, right? So it's again, I think it really questions how fast the Fed can ride to the rescue here, right? I don't think we're going to see much from the impact of Fed policy in terms of really sort of rescuing a lot of the things people are hoping it will in the economy on any kind of near-term timeline. So if you're pinning your hopes on that, I'd really encourage you to reevaluate.
I totally agree. So based on what you just said, I'm of the mindset that actually the Fed hasn't tightened enough. That's just kind of my opinion, because otherwise we wouldn't be seeing all these rosy headlines. And you said earlier that they kind of look at it after it's too late, that, whoa, maybe we tightened too much and now we have to go for an aggressive cut. And that's kind of like my worry about this. Like, I don't think that they really did enough. It was kind of like a pretend fight on inflation this time around. Mm-hmm. And I just don't have confidence that they're going to be able to, get inflation where it needs to be. And people are already struggling now. If inflation continues to be a problem, I just don't see how people are going to continue with the cost of living at this rate. I mean, you can sit there and point that it's 3% right now, but cumulative over the past couple of years, it's 30%. That's a lot of increases.
So that's a great point, which is your number might be even more current than mine, but a few weeks ago I was looking at Trueflation, right, which is a service that tries to calculate inflation. They have a different methodology than the official CPI calculation. But basically their numbers had said that since January of 2020, the cumulative inflation since then had been a bit over 25%. Maybe now it's closer to 30. But anyways, most people I've mentioned that to have said, wow, that's a big number. Although a number of folks have said, I think they're undercutting it.
Yeah.
When I go to the grocery store or fill up at the pump or whatever, it feels like it even more to me, right? But the point is that let's say it's 25%. That means just compared to 4 years ago, your dollar has lost a quarter of its purchasing power in just
Absolutely.
4 years, right? And when you think about it that way, it's kind of staggering, right? If I had told you 4 years ago, Michael, you know, we're going to be walking by beautiful Tiburon here in 4 years, and your dollars are only going to buy 70% of what they do today, I think your hair would have caught on fire. You definitely would have had some action in the hair up there.
No doubt.
No doubt. And I don't know many households back then who said, yeah, I can absorb that, right? Yet here we are, and the injuries are continuing, you know, apace from here. So just to your point about like thinking maybe the Fed didn't cut enough, you're not alone there. And a very important person that you're in company with is a former Federal Reserve official, Thomas Honig. He ran the St. Louis Fed. He was the head of that, and then he served on the Federal Open Markets Committee during the Bernanke era. And he actually has the distinction of having the longest record, unbroken record of dissenting votes, where that was back when Bernanke was considering doing QE. And the lone dissenter on the FOMC for a long time was Thomas Honig, and they eventually just decided to just do it without his buy-in. But anyways, I was just talking to Dr. Honig last week, and he basically echoed your sentiments there. And he said, you know, if it were up to him, he thinks the Fed probably should have continued hiking, or at least should continue a hike from here,
right,
to get the inflation job done, and then move on to what needs to happen. So, you know, his fear, which I think is more or less the consensus of the experts that I talk to, is what's probably most likely from here is that the Fed will start to cut rates as it, you know, over time gets more confident that the inflation rate is dropping down to 2 or lower. And to be honest, you know, there's a lot of folks I talk to who do think it will eventually. They actually think that we may end up having more of a deflation problem than an inflation problem, maybe a year's time from now. So, you know, what they think is going to happen is the Fed is going to start cutting, thinking that, okay, I've engineered the soft landing. Then all these lag effects that you and I are talking about are really going to continue to fully express themselves. All of a sudden, it's going to be clear that the economy is struggling. It's beginning to look like we're truly falling into recession. Companies start laying off people at scale. Home prices start really coming down in a lot more metros. And that's when the Fed is going to say, oh, Jesus, you know what? Maybe we held things too high for too long. And then it's going to panic, right? And then it's going to go back to bazookas and tons of stimulus. And then this is going to be a rinse, wash, repeat scenario where that'll goose the economy. It'll juice asset prices again. It'll make the wealth divide that we were talking about even worse, even more. But then inflation's going to come back, right? And then again, we'll probably be stuck in this loop. And the danger is each time the intervention happens, it's going to require more and more intervention to try to get the same or similar result in the economy.
Yes.
And you can only do that for so long without really big cost. And generally what tends to happen is you end up getting stuck in kind of a binary choice. The big limiter on this system that we have right now is our debt, right? And that's one of the things we're finding right now with the inflation problem, right, is that inflation has driven up interest rates. Interest rates have driven up our debt service costs, right? So I'm sure everybody has seen the headlines that say we're adding, a trillion in debt every 100 days
right
now onto the national debt. And we've seen our deficit explode. And that's exploding for two reasons. One, because our fiscal leaders or our administration and folks in Congress are not cutting back spending this time. They are just continuing sort of COVID emergency level spendings, even though we're not in emergency times anymore. Right. But secondly, the cost of servicing our national debt has skyrocketed because the interest rates have gone up. Right. So eventually you have to say, okay, whoa, you know, we got to try to do something to keep our debts manageable, or else we're going to get crushed under our debts. Right. And the more times you go to the well with these rescue packages, it just makes that system even worse and worse because you're adding more and more debt into the system, and then you're creating more inflation that's bringing interest rates even higher. So something has to give. And generally what gives, because you get boxed into this corner where one of two things has to happen. You have to say, you know what, we're just not going to be able to pay off these debts, and we're going to have to start defaulting on them. No sitting politician is going to preside over that.
Right.
It is political suicide. Nobody's going to run on that platform, and frankly, no one's going to get elected on that platform because it's the kind of pain that voters don't want to take. Right? It may be the medicine we most desperately need, but collectively, we're not willing to vote for it. So if you don't do that, what do? And you basically sacrifice the purchasing power of your currency. Right, that's the casualty. Pretty much in every case we've seen this in history. That's what happens.
Unfortunately,
right? And we're seeing it happen right now in real time in countries like Japan. Right. The problem with that, lots of problems with that, but the problem with that is when we have this growing wealth divide you and I were talking about. What that means is just your dollar buys less and less, and so this bottom 90% that we've been talking about that's getting worse off, starts to get worse off at a much faster rate, and it has a much harder and harder time getting out of that gravity well of purchasing power destruction. That's what I kind of feel like is the big risk here. Now, again, folks, this isn't happening tomorrow. I'm not telling folks to panic and liquidate all your current portfolios because you think this is going to happen, literally this month. I'm just saying, based on the people that I talk to and based upon scope of history and what economic history has shown us, this is the trajectory we're on unless something, really material happens. And there is a chance that some material things might happen. We might change our behavior, right? And we could start reducing our level of deficit spending. We could be adopting more prudent fiscal and monetary policies. I think the odds of that aren't very high. I think those type of behavior changes are going to be forced on us, not ones that we're going to adopt proactively. Another thing that could happen is we could grow our way out of this. We could enter an era of dramatic and sustained higher than average economic growth. Again, I don't think that's super likely. That's kind of the promise that AI is offering us right now. I think there's a lot of challenges with the current AI narrative, especially the kind of AI mania that's going on right now. I don't know if you want to get into that in this discussion or not, but absent some sort of unexpected massive technological innovation that unlocks that, again, I just don't see that happening. But I do keep the door open to the fact that things could happen that could change this trajectory. But because I don't see anything that's likely to change it, I think we have to look ahead and say, okay, we need to prepare ourselves for the likely progression that we're heading into here.
I agree. Yeah, I've heard you say on your channel a few times before that the only time they're going to probably do something about this is when there's nothing else left to do. That's when people start doing the right thing, right? Whenever there's no other option left, then maybe that's when they'll start to turn it around. But as long as there are ways to kick the can down the road, then that's almost a certainty at this point.
Yeah, I mean, that's generally human nature, sad to admit, but I think it is almost always the political way.
Yeah, and you like your analogies. Well, here's one for you. America is like a junkie, and debt is our drug of choice, and we're about to OD.
Yeah. I think that's really true. Or, we could go cold turkey, right? I just don't think America would handle the withdrawal. And again, I don't see a politician who's willing to try to sell to the American people what the pain of withdrawal would be like to go through. Right?
Absolutely. Ever since our last chat, which was almost a year ago, it was about 10 months ago, we were talking about the similar topics we are right now with consumer sentiment and this potential recession and everything. But the reality is a lot of the numbers have in fact gotten worse since then. The consumer sentiment data has gotten worse since then. The credit card debt has definitely gotten a lot worse since then. The delinquencies on all forms of debt have gotten worse since then, most notably credit card debt and auto loans, and the mortgage debt has been ticking up, student loan debt as well. So people have basically stopped paying their bills. That was one of my most popular videos I did this year, and I think it's popular because people know it's true. So, I mean, we're seeing things that are actually happening in real time in this economy that show you, people don't have the money for things, but yet a lot of people are saying that it's actually better than ever. And I think part of that problem is, like you said earlier, you have the top echelon of people that, just everything's great for them. They're reaping the massive benefits from what's going on right now, but that's not what's happening for, 80-90% of the people out there.
Exactly. This kind of goes back to that sort of average versus median, right? And because the rich are skewing the averages, they've kind of been able to carry everybody along to a certain extent. But you're right, you can't do that forever, and you've got your eyes on the right places, right, which are these leading indicators,
Yes.
right, that are showing us increasing signs of worry. But they're leading indicators, right? So it takes a while for the other indicators that aren't so leading to catch up with them, right?
Sure.
What's interesting is I talk up, I've said for a long time, these affluent can only carry the total consumer spending for so long, because you get to a point where, like, you don't need any more mansions, or you don't need any more jet skis, right? And this morning I was looking at some new news reports. So John Rubino is an analyst I talk to quite frequently, and he, for years, he's told me about his RV indicator, which he thinks is kind of an interesting early indicator for, entering periods of consumer spending recession. Because an RV is kind of the epitome of the toy you don't need,
Right.
the expensive toy you don't need. So we are seeing RV sales off dramatically. They've fallen dramatically over the past 2 years. Winnebago just got walloped a few weeks ago because it missed its Q2 sales targets. And then today we had Polaris. Same thing happened to them. They missed their sales targets. They make ATVs and jet skis.
Yes.
Right. So we actually now are beginning to see in real time that consumer spending on the discretionary toys is really beginning to dry up here, right? So again, just sort of more leading indicators that suggest these are the things that we would expect to see as we'd be going into a recession, right? And one of the things that you mentioned in your excellent list there of leading indicators you looked at were consumer delinquencies. And when you look at consumer delinquencies, especially for things like auto loans and even mortgage loans, where you see the biggest spike in delinquencies are when people, when asked why they're delinquent, they're saying loss of income. So we're actually now starting to get to the point where the layoffs that have been happening over the past year and a half are starting to bite to the point where they're actually impacting some of the national numbers, right? So we're not there in big enough scale yet for it to start bringing down the overall national averages, but we're now getting close, right? And I do want to note on I'm not sure if it was today or just earlier this week, but the latest housing market data is out, and the national average sale price
is up again.
Hit a new all-time high, right? So this is exactly what I'm talking about, right? So the housing prices, the average national housing price has never been higher, right? Now transactions have dried up, right?
They've never been lower.
They've never been lower, but also inventory is 24% higher than it was a year ago.
Yes.
Right? So you just look at the headline number, you just look at the average, and you say, everything's great, right? But then you look a little bit below the surface and you say, whoa, no, these other trends are trends we would totally expect to see in a sick market, right?
Yes, absolutely. Well, speaking of real estate, there's a couple of things I want to mention about that. First of all, I've gone over some data in some recent videos I've done, and the first thing that I noticed is that there are a lot of people out there right now that have bought homes, say around 2022, at the height of the market back then.
Yeah, had the FOMO.
Yeah, had the FOMO. And this median number that we see as the headline, where prices are still going up and it's the highest they've ever been, that's only on the national median home price. There's a lot of markets across the country where things have gone down since then consistently, and some of them have gone down so much that actually the value of the homes today are worth less than they were in 2020. I had some charts I can put up and show people this, but people bought into that big time, thinking that, whoa, I'll be able to refinance. They were lied to by their real estate agent and their mortgage broker that you can refinance, and by the end of the year, rates will be 5.5%. Well, that never happened. And now you're seeing a situation where people are stuck with these homes where the payments have gone up unbelievably high because of higher insurance costs, higher property taxes, things like that. And yet all people can see is that the median home price is at a record height, and that's the sign that real estate is doing good.
Yeah, so there's so much to unpack in there, and again, this is where I think guys like you and I who watch the markets closely, we kind of sometimes feel like we're taking crazy pills that everybody else is seeing the same thing, right?
Right.
So first off, on the FOMO, one of the people that bought during those FOMO years, that was when, like, oh my gosh, we're all going to be able to work from home forever. Everybody had a little extra money in their pockets from the checks directly to households, and You had the forbearances on a lot of their other costs, and people thought like, oh, my student debt's going to get canceled. And so people were feeling more flush than normal, and they were being bombarded with messaging that, oh my God, if you don't buy a house now, you're never going to be able to afford.
Even now, still today.
Even now, still today. But back then, where I'm going with this is, oftentimes when the mania gets at its craziest, it's the people who will get hurt the most, the people who can least afford the losses, who get sucked in, and they're least able to afford the costs of this whole thing unwinding, right? So you had a lot of millennials and even some Gen Zers, get caught up in the pressure, super stretched to buy a house, right? And then what happened, right? Then all of a sudden they realized, oh,
property taxes aren't fixed.
Well, first, I think a lot of them just realized that, like, oh, wait, actually owning a house comes with a lot of costs that renting doesn't, right?
Right.
They had kind of this sense of like, whoa, wait a minute, maybe I wasn't prepared for this. And then we had the knock-on effects that you talked about, right? Which is, okay, so home prices go up dramatically, and they went up crazily during COVID, largely because of the stimulus that was flooded into the system. So that created price inflation in housing. So there are all these other things that mathematically have to go up in accordance with that, like insurance. Oh, your house is more expensive now. You need more insurance, more expensive, right? So we've had insurance rate costs go bananas. That also coincided with the insurance companies. They had already been trying to think of, in certain regions, trying to think about, well, how do we reprice some of the risks of these regions, like hurricane risk and Florida, or fire risk out here in California. And so those corrections came in at the same time as these insurance hikes. Then you had property taxes go up again, because in most states they're tied to the appraised value of the house, which went up. And then you've had the cost of maintenance and repairs go up dramatically, right? So it's actually gotten a lot worse to be a homeowner.
Absolutely.
But prices haven't reflected that, right? And just think about this in a steady state model. Right, like let's say I said, Michael, there's a home, it costs X, right? The insurance cost that home's going to go up by 20%, property taxes are going to go up by 20%, and cost of maintenance is going to go up by 20%. What should happen to the price of that house, all other things being equal?
Needs to come down 20%.
It needs to come down, right? It needs to reflect. Those increased costs are like an increased discount factor on that asset, right? But that hasn't happened yet, right? So when I talk about, at the very beginning, I said we're in this inflection point. We're right at that tipping point where all of a sudden, all these changes that have happened that we haven't seen manifest around us, the implications manifest around it, we're going to start seeing that manifestation unfolding from here, right? And I think that's right where we are. You can call that the Wile E. Coyote moment, right, where he's just hovering in midair yet, and gravity just hasn't quite yet kicked in. But I feel like that's kind of where we are right now with housing, and basically with almost all other assets.
Yep. So I did a quick search, here in the North Bay, Santa Rosa area for some home price data, because you live up here.
Yep.
A couple things I found. Number one, the home value growth here has been, not that exciting here. It's only been 2.7% year over year, so not huge numbers. And also, the inventory here has climbed substantially, actually. In this area, the inventory has gone up 46% year over year. And the price cut percentage has also gone up. And at the same time, the buy versus rent differential here is right around double. In fact, it costs about 97% more to be a homeowner in the area you live in than being a renter. And I remember last time we talked, you said you were renting and you wouldn't buy in this environment. Is that still the case for you personally?
That is still the case for me personally. And look, buying a home is it's a personal decision. There are lots of different factors that can go in. Not all of them are economic. So if you're looking to buy a home here, I'm not trying to criticize you. But to Michael's point, if you just look at it from an economic standpoint, man, I don't know why you would be buying a home right now, especially given the outlook from here. I think if you just wait a year and see what unfolds, you might be a lot happier as a home purchaser 12 months from now.
Yeah, and you as just like, a smart guy financially, you would think that it makes a lot more sense to be a renter right now, because you're literally saving half of your money. You'd be spending double if you were a homeowner. That'd be going towards a house payment. And I'm sure you can find a lot of other good uses for that extra money right now.
Well, you can, and also too, just to give some perspective on how it works up here. So if you own a house up here, you're basically thinking, okay, you know what? This is an attractive place to live. There's a lot of people that want to live here, both from San Francisco, which we can see across the bay there, where, again, COVID sort of let people imagine what life might be like outside of the city, right? So there's a lot of rich people that want to have a second home up where I live, or dream of, one day I'll be able to work from home forever, and I can get out of the city and I can live up in the, by the vineyards where it's really pretty, right? So you're thinking, okay, one of those rich people from the city is going to come and want to pay more for my house than what I bought it for. Or increasingly, there's a lot of people from other parts of the country that want to come here too. I mean, Michael, you're spending your summer here and you're from Florida, right?
Right.
A lot of my neighbors are from Texas and from other states that have visited here, fallen in love with it, and they were wealthy enough to say, yeah, I'll buy this house here, right? So you're basically expecting that trend is going to continue, right? And maybe over the next 20, 30 years, yeah, sure, maybe it will, right? But just factor in the following, right? Let's say we have this recession that you and I think is going to happen. Probably more likely than not going to be accompanied by a pretty substantial correction in the financial markets, right? We were talking about how overvalued they are right now, right?
Yep.
Well, all of a sudden, there's a lot less of those people who are from the city or from outside of state who are now going to have the means to come and make that purchase, and certainly make it at a premium to what you're expecting to get today, right? When we're still in quote unquote the good times, right? So you might find yourself all of a sudden in an environment where that buyer you were counting on isn't around for a half decade or more, right? So you have to be very careful about taking that risk.
Yeah, and something else, Adam, like here in California, for example, is like kind of the perfect example of a housing market pretty much anywhere in California where it's way cheaper to rent than it is to buy. And a lot of people ask, like, well, why is that? It's because a lot of people here bought properties 20, 30 years ago, locked in those low prices. They don't have a mortgage payment anymore, and they can still rent those properties for a profit. But
right.
One day that's no longer going to be the case. One day they're going to sell those houses. Someone else is going to own it. They're going to have a much higher cost to operate that house. They're not going to be able to offer those low rents anymore. And once you reach a situation where the rents are not low because the new owner can't afford to keep it low, and the home prices are still too high, and nobody can afford those payments, that's yet another thing in the future that can put downward pressure on this area that a lot of other places don't have to worry about.
So I completely agree. One thing I'll say is the rents are not that low here, just FYI, but those people have a nice fat margin, right? And to your point, the person who buys the house from them does not have that margin anymore, right? So no, you're totally right. The thing I would add to it, which is sort of universal for the country, is, I gave a scenario where things could dry up here in the nearest term, right? Next 5 years-ish or so. Now let's fast forward 10, 15 years.
Yes.
All those people who bought their homes up here really cheaply, right, are now, today are likely boomers. 10, 15 years, those people are having to leave for the nursing home or for the funeral home.
Yeah.
Right? This is just demographics, right? There is going to be a period of time, probably measured in decades, decade or two, where that tsunami of baby boomers, who first were entering the workforce, now are leaving the workforce, are going to be leaving this world. And that is going to be placing an unrelenting downward bid on housing. Right, yes. Because in most cases, their houses are going to have to be sold to meet the estate needs of their children. Right, most of those boomers will have multiple children. Probably decide neither of them wants to live in the house, and they'd just rather, to make it fair, sell it and split the proceeds. Right, so we have my short-term concern, but then we have this longer-term and not much longer term demographic one, which doesn't leave you with that much of a window to say, you know what, I'm going to really stretch myself on a house because I hope between years 7 and 11, I can sell it for a good profit before either of these two things might take me out, right? Yeah. And again, I'm not saying not to buy a house. I'm just saying, there are these, these extraordinary risks that we haven't really had in the housing market for the past couple of decades to make sure you keep in mind.
Now, one thing you said last time we talked is that real estate could become a much riskier investment to the point where a lot of people might want to shy away from it, due to maybe the abysmal amount that it's coming down by. And, I even personally exited the real estate market is an investor. I don't own investment properties anymore as of the beginning of this year. The costs have climbed so much to the point where it didn't make sense. You couldn't actually make money anymore. And for that lucky reason, I'm out of it. But, you know, just now, like 2.5 years later, after buying my primary residence, for example, my personal payment has gone up $1,100 a month. When you're talking an increase in property taxes, an increase in HOA fees, a special assessment to keep up with building maintenance, all of those things, you know, and have gone up to the point where I'm $1,100 higher than I was 2 years ago. And I don't think a lot of people can handle an increase like that. You know, that's another big problem that people face.
Yeah, and so, you know, buying real estate, becoming an owner used to be the solution to that, right? People would say, don't be a renter. You're always at the risk of your landlord hiking rates, right? You don't have control over your costs.
Yeah.
Become an owner, you can lock in all your costs and know what they're going to be going forward. You know, and there's still a lot of truth to that, but not as much as there used to. You know, we've all just kind of learned that, whoa, all these other ancillary costs can go up by an awful lot, and I don't have any control over that.
Absolutely.
Right? So I do think that's a really important thing to keep in mind. I'm not trying to villainize housing here, but I do think that housing especially has sort of been a case of kind of having it too good for too long, you know, especially if you've been a homeowner. We're rationalizing creatures, human beings are, and you start to feel like, well, no, we deserve all this, and you know, and this is the way it should be forever, right? And so you think any changes to the status quo are impossible to happen, and if they do, you start feeling like a real sense of injustice about it. So here's what I think could happen given how overpriced real estate is right now. And obviously real estate's super local, so I'm painting with a very broad brush here, right? Certain markets where I'm sure real estate's still a very good investment, either as a primary resident or as a investor, but there are a number of factors that I think the shoe has to drop, or there's a series of shoes that have to drop, and you just need to be aware of them. One is that prices need to come down for all the reasons we talked about, right?
And they already are in a lot of places.
So that's, you know, you're absolutely right? So if we look at the national average, no, everything looks fine. We look at Austin, or we look at some markets in Florida, and they're down 20+%, right? It looks like a freaking bloodbath, right?
Yeah.
And I think what we're seeing is in the hottest markets, and this is kind of how capitalism works, right? You had a ton of developers building inventory in these markets. You had a lot of hype, you know, driving a lot of people there. A lot of people probably got loans they shouldn't have qualified for to get in. And all of a sudden, you're seeing a period now in these markets of oversupply, right? Where you're actually having not just a supply problem where supply is beginning to get higher than the market can absorb, but you're having a demand problem at the same time, right? And again, you're going to see that first where things were hottest, and that's why Austin and a lot of the Florida markets are now suffering. The question is how wide does the contagion spread, right? And for reasons we can talk about, or folks can just take it at face value, I think it's likely to spread more than most are currently imagining right now, right? But the bigger issue here is that we might have talked about this last time, but it's worth repeating. One of the reasons why we sort of have a housing inventory problem in this country is because the boomers didn't downsize the way that they were expected to. Right. They were going to, you know, once they were empty nesters and getting older in life, they were going to sell their main residence and they were going to downshift to something more modest. They either didn't do that, or they did, but they didn't sell their prior house. Right. Because they started looking at it just like a stock in their portfolio. Hey, this thing goes up every year. Maybe I can rent it out and it's an income stream for me, right? You know, or they just stayed in the big house and they said, look, this is my retirement plan, right? I have all this home equity. That's what I'm going to retire on, right? Imagine what starts happening if your local real estate market starts to go the way of Austin, right? Where prices start coming down, they start coming down further. You're going to say, whoa, wait a minute. Like, I'm now losing equity. I'm now losing my retirement plan. I don't want to be the sucker that sits on this thing and rides it to the bottom. So there's kind of a first mover advantage to when you start losing confidence to be one of the first to sell. All right, you know what? I'll lose 5% of my home equity. I'm cool with that. You know, at least I'm not losing 30% of it, right? The problem is not everybody can be the first 5% to liquidate, right? So you start having this cascade going down as people get more and more worried. I think that's something that could easily happen in probably more markets than folks realize here. And of course, you throw a recession into the mix where people are actually losing their incomes, and it's no longer a calculated choice of when to sell. It's I have to sell because I no longer have an income. That just pours jet fuel all over that fire.
Yeah, absolutely. So that just kind of brings me up to my next point, because like right now in this current housing market, like we just briefly talked about a minute ago, was that inventory is up 25% year over year. The sales have never been lower than they are right now. 2023 was the worst year on record. 2024 looks like it'll be the next worst year on record in terms of how many closed sales we have. And right now, we also see a situation where the foreign home buyers that used to come in and buy up a lot of our real estate, they have disappeared as well. Those numbers are now at the lowest record that they've since they started keeping track in 2009. And a lot of people say, oh, well, when the inventory comes, if all this panic selling happens that we're talking about here or whatever, then BlackRock and all the foreigners, everybody's going to come in and buy all this real estate. Well, we're already starting to see the inventory tick up now, and that's not happening. So, you know, a lot of people have this notion that these guys are all going to come in and save the day, but it's already happening and we're not seeing that. So do you think there's any merit to that thesis?
Yeah, so I think a couple of things. So the drying up of the foreign investor capital, I think you'd be hard pressed not to think at least a healthy amount of that is due to the fact that this slowdown that we're talking about looks like it's beginning to unfold here is happening globally.
Yes.
And the US is the strongest player on the global stage. So not a huge surprise that people from other countries first will curtail their spending. Right, so that's probably a validating sign of what we're talking about on a macro level, right? Now, from a institutional buyer standpoint, I think we talked a bit about this last time, and I don't know if we want to get off on this tangent. You know, I'm not a big fan of institutional money in the single-family home market. I think it creates a lot of problems in the long run, but putting all that aside for a second, those guys have largely stopped buying, and the reason for that is that's the smarter money, right? I mean, these are the professional investors who the decision to buy these homes is a purely spreadsheet one for them, right? So they're not being influenced by emotion or any of the non-economic values of, well, I want a nice place, with a good school system to raise my kids, right?
Yeah.
They're looking at it with just a ruthless economic lens, and they're saying it just doesn't pencil out, right? So we're stopping buying, right? So again, that should be a signal to you that it's, times aren't good from an expected return standpoint. Right. So the other issue with those guys is, while they're the smarter money, they're not the smartest money. And, in certain markets, and I think we're already beginning to see this with certain firms in places like Florida, where they're taking big losses now, they're much more likely to say, oh, you know what? Yeah, I just reran the numbers. This is a bad investment for us now. Just liquidate it.
Yes.
Just get it off the books, right? And all of a sudden, that can dump a lot of inventory on a market all at once and create a real supply spike and a real price downdraft, right? So I think you need to be probably more worried about that than those guys stepping in tomorrow and rescuing the prices.
Yeah, and my personal opinion on it is like, yeah, could that happen in the future? Sure, but I think it's going to have to get to a scenario like we saw in the last housing crash, where we have 4 times as much inventory as we have right now in order for that to happen. You're going to have so many homes on the market where they can pick them up at bargain deals in order for institutional investors and foreigners to come back.
So I agree, and then I just want to ask this question, which is that something we want to root for? Do we want to root for corporations and foreigners coming in and buying our residential housing stock? I mean, multifamily, I can see that argument, but single family homes where American families are aspiring to live, right? Right now, you probably know the numbers better than I. U.S. homes, the U.S. single-family house is at a record level of unaffordability.
Yeah.
I read a stat recently that 40% of all renters have given up hope of ever being able to afford to buy a home, and that's up from like 23% just a year ago.
Yeah.
Right. So when your populace gives up hope of being able to actually afford the basics of the American dream, like a home to raise my family in, I think nothing good societally comes from that. So I don't understand what the benefit is of letting a Blackstone or a Chinese national own a house on my block because they can outbid me for it. And by the way, those guys have much greater advantages over the average aspiring retail home buyer, right? They've got lower cost of debt, they've got economies of scale, they've got all sorts of things that the average person doesn't have. It's not a fair fight.
Right. Well, if you think about it, it's good for local governments because the more houses that are being sold, the more document stamp fees they collect and closing costs they collect, the higher property taxes go because the higher prices go. So for local governments, they love that kind of thing. On a national level,
but who are local governments supposed to be serving?
Exactly. I 100% agree. Just goes to show you what they care about. What's their true motivations here?
Yeah, and this goes back to why I think like a lot of the reforms, a lot of the behavior change that could get us out of these bigger macro problems, I think are going to be forced on us because it's our short-termerism, our greed, our short-sightedness that's going to make us prioritize choices like what you're describing versus what we should be doing.
Yeah, we won't have a choice at some point in the future. So earlier we talked a lot about how the economy has, definitely worsened in ways that we can actually track. We see unemployment data, we see the spending data, delinquencies, all that stuff. Now, this area that we're walking through is a very affluent part of the country. Have you seen anything like this here, where people have slowed down on spending? Have you heard neighbors, friends, colleagues, talk about how things have shifted since the last time we talked?
Yeah, we have. I don't think we're anywhere near sort of like recessionary levels yet. Definitely we've seen some job loss, and some job loss where people have expressed, wow, I didn't think I'd be out of work for this long, right? That it's actually materially harder to get a job.
Yeah.
And that's maybe just a quick little tangent. We've been told for years and years how robust the U.S. jobs market is. Right, and for years, Jerome Powell has talked about how we've had this massive delta between job openings and job applicants, and he's trying to normalize the job market by taking some of the froth out of it. On my channel, I've talked a lot about how a lot of the data that he's using when he says that is quite suspect. When you compare it to both the number of layoffs that have been going on, the number of award notices and things like we talked about earlier, they really fly in the face of these low, stable unemployment numbers. But anecdotally, when you talk to people all over the country, you hear a very different story. Like when Powell speaks, he says, yeah, there's still more applicants than more job openings than there are applicants. Super easy for people to get a job. That's not what I hear when I talk to real people, whether it's recent college graduates.
And that's here in the Bay Area.
And that's here in the Bay Area, and with people who have decades of direct experience in what a lot of these companies are purportedly hiring for. In fact, it's kind of like not even a very well kept secret that most open recs on company websites, they're not actively hiring for.
Right.
They're just there really for optics.
Yes.
So I'm definitely seeing more people kind of run afoul of that, where they've been let go in a selective layoff at their company, and then they go to try to find another job in the same industry, and they're just not finding any open doors. I would say the bigger issue that I've seen in my area over the past number of years is that as more and more the wealthy people moving up here from the city, it sort of moves of choice. Someone saying, oh, I'd love to live in the country rather than live in the city, or I'd love to live in wonderful California versus hot Houston or whatever. That has really pushed out the families that grew up here. And so we've seen a real forced exodus of people just because they can't afford to raise their families in the town that they grew up in.
Yeah.
And while I think if we go into the type of recession I think is going to happen, it probably will slow the amount of people coming up, and it'll slow that displacement of new, more wealthy people coming in. But at the same time, I think it's going to make it harder for these people on the lower end of the economic spectrum to meet their basic needs. So I do worry for that. We're not there yet, but that's, as I talked about, us being at the tipping point. I kind of expect that to be the next act that we'll be falling into over the next 6 to 12 months.
Makes sense. So I normally don't talk anything really political on the channel, but a lot of things in politics have happened over the past couple of weeks. Biden dropped out of the race. Trump almost got assassinated. And one thing I constantly keep seeing in the comments section of my videos, you probably see this too, is that people are tired of this economy for sure, And everybody thinks that if Trump gets elected, he's going to magically turn this whole thing around.
Yeah.
And I don't know what your take is on that, but I feel like everybody who thinks that is just, they completely don't have their eye on the ball, because a lot of these problems that we talk about here, Trump isn't going to be able to fix hardly any of them. He might be able to fix, issues with the border and immigration, and maybe, keep taxes lower for a little while longer, things like that. But I don't think he's going to be able to tackle a lot of these big issues that we have right now.
Yeah, and like you, I chart a very nonpartisan, apolitical course. But you can't talk about the economy without talking about political decisions that impact it.
Because everybody blames the president.
Right. So first off, at the highest level, it doesn't matter whether it's a Republican or a Democrat, sitting in the president's seat. We are so far along in the problem that has grown over the decades, which is our debt.
Right.
Right.
And neither candidate wants to do anything about that.
Yeah, and they've proven over the past bunch of decades that whichever administration's in office, no matter what their outward platform is, they've all left office with more debt than when they went in there. Right. So deficit spending is just baked into the modus operandi of Capitol Hill at this point in time. And honestly, I don't even think it's feasible for a president who came in, if they said on day one, hey, everybody, forget what I said, all I'm going to care about is getting our national debt down. I'm not even sure that's feasible the way the system is currently structured at this point.
Yeah, probably not.
Probably not. So at the very big picture, I'm not sure it really even matters that much.
But a lot of people think it does matter.
A lot of people think it does. And part of that, I think, is there are noticeable differences between the candidates, and we can talk about them in just a second. Part of it is a little bit too, humans are rationalizing creatures, not rational creatures, but rationalizing. We like to engage in magical thinking. We always like to think we can sort of sidestep the pain, right? And okay, maybe somebody new comes in and does something better and magically fixes it all for us, right? So I think there's a little bit of that going on. Now, definitely people can say, hey, look, let's compare life under Trump and life under Biden. And yeah,
right. That's what everybody does.
Yeah, right. And I think that's probably the main reason why Trump is leading by as much as he is right now, is that key question of, are you better off now than you were 4 years ago? And I think for most people economically, they'd say, well, 4 years ago, I felt better off.
Right.
Now, to a certain extent, in Biden's defense, and I'm not defending his administration, but we had the curveball of COVID, right? And that really, would Biden's administration have had 9% inflation if it weren't for COVID? Probably not, right? So it's not necessarily the fairest of comparisons, but look, I think the stuff that Trump is planning on doing, from my understanding of the current Trump economic plan, which I was reviewing the other day, it does very much seem to be taking a lot of pages out of the Reagan playbook. And folks, if you want to understand that in greater depth, I did an interview probably about 6 months ago with Art Laffer, who has been a presidential economic advisor to a number of different presidents on both Republican and Democrat over the decades. We went pretty deep into the Reagan playbook, and I have seen recently that Art Laffer is now on Trump's Council of Economic Advisors. So if you want to sort of really understand the Trump plan in depth, highly recommend you go watch that video. It'll help you understand kind of the key points that they have in place there. But just pulling a few of them out, if Trump executes his plan, as I understand it, it's going to take a while for you to start seeing results. And some of these things will play off of each other, at least for a certain while, right? So let's take tax cuts and tariffs, right? So Trump plans to use tariffs to basically make it harder for foreign companies to compete against American companies, right? That's good. That should hopefully allow over time American companies to pay, competitive wages to its workers, to produce more products here at home, right? But that's going to make products of all stripes more expensive, right? Yeah. So, okay, how do we offset that? Well, we reduce the corporate tax rate maybe down to 15%, which is the current proposal in Trump's plan. That will help increase corporate profits, which in theory should allow them to afford to pay the wages that their workers will need to make all that happen, right? But that's not all going to roll out at the same pace, right? So again, whatever success the Trump plan has, it's not going to be sunshine and roses from day one. It's going to be a ramp up, and at times certain forces are going to win out over other forces, right? So to your point, I think it's unwise to put all your hopes on everything being, instantly better when the next candidate's in office. And let me just say one last thing too. So there's a theory I've had on my channel that I mentioned a couple of times, and when I was talking to Anna Wong from Bloomberg, she said, oh, there's actually a rule out there. I can't remember the guy's name, but there's a rule named after this guy who basically says the same thing, which is regardless of who wins the election in November, both candidates have they have an incentive to let the system kind of go through a hard correction right afterwards. So if you're Harris, right, I think nobody would disagree that the Biden-Harris administration is doing everything, throwing the kitchen sink at just keeping things held together as rosy as they can until we get to the election, right? So they're doing a lot of unnatural acts to prop things up. They know they can't do that forever, right? So once the election comes, I could easily understand the logic of, right, okay, we just want another 4 years. Let's let the froth come out of all this, right? Let's let things correct. Yeah, it'll be painful here for the next year, but it'll lower the bar. And then we can finish strong in our last couple of years and feel good about it, right? Similar thing if Trump wins. So first, if Trump wins, of course the current administration is going to stop doing everything they're doing, right? Screw that guy. We're going to
throw him under the bus.
We're going to let him inherit all the problems here, right? So they'll do that right away. And I think Trump will be like, great, let it happen, because I can blame it on you guys for my first 2 years, and it'll lower the bar, and then I can finish strong in my last 3 years, last 2 years. So, I can't guarantee that's how things are going to play out, but that makes a lot of sense to me. I definitely would just keep that in your mind if you're, trying to predict what's happening from here, that I think there is a real incentive for both parties to let the worst of the froth bleed out, and maybe bleed out in a somewhat painful way in the half year or so following the election.
Yeah, and that pretty much lines up with, what we've all been expecting and hearing, that there's probably going to be this official start of this recession, right after the election. That kind of lines up with this whole theory that they're both going to just let it go. And, a lot of people say, well, if Trump gets elected, then they're just going to blame it on him when things go down. And that's fine. They can blame it on whoever they want. But the reality is, this whole thing has been brewing for quite some time. And like you said, I am in agreement that it doesn't really matter who gets elected, from the point of view that this is going to happen whether we get Trump or we get Harris or somebody else.
Right.
So,
well, and I hate to sort of end on this note, but like the thing I feel the most confident about as we move forward into the future, regardless of who is sitting in the White House, is the biggest threat over time is going to be to the purchasing power of our currency.
Yeah, unfortunately. Well, that's a great last question I want to ask you here then, Adam. What is your advice, or what are some things that you're doing right now that the average person can do to make sure that their purchasing power doesn't get completely obliterated by inflation?
Yeah, great question. So what you have to do is you have to invest, right? What you need to do is you need to take your wealth. You want to obviously increase your wealth, and you want to increase your wealth at a rate that is equal to or faster than inflation.
Yeah.
That's kind of your goal going forward. That is your financial goal going forward. So, depending on your age and where you are, you might prioritize certain things over others, but just to get to the basics, there are three muscles that are really important. One is the earning muscle, right? The second is the saving muscle. The third is the investing muscle. And if you haven't done a good job on those first two, the earning and the saving, prioritize those two first. But then once you've got those in a good place, take all your excess savings, start putting that to work for your long-term benefit in investing. This is a little bit talking my book, because this, what I do at Thoughtful Money is I educate people about what's happening in the macro world so they can make smarter decisions with their money. But then, a lot of people who are out here watching videos like yours and mine, they're here self-educating because they don't want to become collateral damage to these forces. But a lot of them they don't feel confident managing their money on their own, but they haven't found an advisor that they trust enough yet or feel comfortable enough yet. Mm-hmm. Which I commend them for, which is, don't give your money to somebody that you're uncomfortable with.
Yeah.
But I understand, given that the failures of our education system, that most people don't have a good grounding in the fundamentals of investing. They don't have the expertise that a good professional does, because they have real lives. They have a job, they've got families to raise, stuff like that, right? So I can understand the anxiety that a lot of people feel of like, yeah, I'm managing my family's money right now, but I don't feel good about it. So I would say to that person, your job then is not to try to figure out what's the next best investment to put in your portfolio. Your job is to find a good financial professional advisor who takes into account all the issues that you and I have been talking about here, Michael, who can be your financial quarterback and then help you recruit a financial team around them. So a good insurance provider, a good estate planner, a good accountant, that type of stuff. And really, leverage the expertise of professionals to do this job for you. Because a good professional who understands this, a good professional knows their job is to beat inflation for you, right? It shouldn't be to promise you they're going to beat the S&P year in, year out. Nobody can really do that consistently, and those guys are just trying to steal your money, basically. But a good investor, a good investment professional says, all right, tell me your goals. I'm going to help you hit them. But in most cases, my goal was to help you beat out inflation. And I'm going to do that by taking on the least risk possible to be able to do that, right? So I think finding somebody like that to help you is the way to go. Now, in terms of specifics, we are in this rare moment of time where inflation is coming down, right? There is a lot of risk in the markets, and you can actually get a real return right now by sitting in the safest asset or the safest financial asset, which is short-term U.S. Treasury bonds. That's not a bad place to be right now. Just to get more clarity on where things are headed, to earn 5+%, beat inflation at least as reported in the CPI, and not take on too much risk. Not a bad place to be. Obviously, I think you want to have a healthy amount of diversification in your portfolio in general, but more often than in the past, more than in the past, I think it's important to really be holding onto certain assets that can't inflate away, that do provide inflation defense. The classic things are things like precious metals. If you are intrigued enough by the crypto space, maybe some Bitcoin, commodities, and I think there's a lot of data that shows that commodities should perform much better relative to equities going forward over the next decade or two, because there's a cycle, and they've spent the past 10, 20 years on the downside of that cycle. But I'm not saying don't invest in the general markets as well. Equities over time are one of the best asset classes to beat inflation. You just have to be very careful about choosing your entry points given how overvalued things are right now.
Sure.
So again, this is where a really good advisor comes into play, because we've lived through a period of time, really pretty much post-2000, but certainly post-Great Financial Crisis, where the passive approach worked really well. You just bought the sector. You really could almost close your eyes and throw a dart and buy every dip, and the markets would inexorably, go up year after year after year. It was pretty easy to make money. Now we're at a point where the markets are concerningly overvalued for all the reasons we talked about. There's a variety of pins lurking out there just waiting to puncture that bubble. And so if you're going to be buying into the market at this point, you have to take a much more active approach where you're not finding the sector or the momentum play. You're trying to find the undervalued jewel, right?
Yes.
The diamond that's hidden in the dirt, right?
Something that still has long-term growth.
Yeah, long-term growth, and there's a mispricing right now where the market is just not seeing its value for what its true underlying value is. Those are sort of a lot of the initial areas that I'd recommend that folks look at. But in general, again, focus on the basics. Earn as much as you can. Try to increase your revenue streams. When you go into a period of recession, the secret to success there is not losing your income stream. So, if you can either make your current income stream more dependable or set up multiple streams of income, so if you lose one, you're not going to zero, you still have other forms of income coming in. Very important. Make sure that you develop your savings muscle as you get as aggressive as possible. What's the maximum amount of my income coming in every month I can put away? And then again, deploy that into your investments in the way that I talked about it here. One maybe perhaps shameless self-plug here is if you are having trouble finding a financial advisor who addresses the issues that Michael and I have been talking about, or maybe you just want a second opinion from one who does, you have a current advisor but you'd like to hear from another, then you're welcome to talk to the advisors that are endorsed by Thoughtful Money. And to do that, just go to thoughtfulmoney.com, fill out the short form there. You'll have a free consultation with these guys. It doesn't cost you anything. There's no commitment to work with them. There's no strings attached. It's just a free public service they offer. And it's one of those things that's like, why not do it? You can't lose. You'll just get some
Right.
good customized information. You can take that to your existing advisor and say, hey, I talked to these smart guys. I like their ideas. Why don't you implement them for me? Or if you're a DIY guy, just take their advice, do it yourself. Or if you like them, keep talking to them. Totally up to you.
Yeah, that's fantastic advice, Adam. And I really appreciate you coming on my show today. I hope everybody learned a ton from this. I know I sure did. So if you enjoyed this video, first of all, go to Adam's channel, Adam Taggart at Thoughtful Money. Subscribe, check out his videos. And if you enjoyed this video, make sure you're subscribed to my channel. And if you don't want to wait for my next video to come out, check out this one on the screen right over here. And I'll see you in the next one.
Thanks, everyone. It's been a joy, Michael. Thanks, buddy.
You bet.